Kathy.
Welcome back to the Real Estate Connector. We're now on episode 4 of season 2, and each episode has been building on the last.
Well, in episode 1, Kathy shared her transformation journey. Episode 2 was about cash flow and awareness. And episode 3 introduced financial visibility framework. Today we're going to go deeper into expense mapping and the chart of accounts. The question we're answering today is, where did the money actually go? And more importantly, does your accounting system tell the right story?
Yeah, so when it was brought to my attention that although I knew what the chart of accounts were, my accountant at the time never questioned me about them or validated them or confirmed them with me. So we don't even know with the previous tax returns how accurate that might be. When we started rebuilding Applewood's financial system, we discovered something surprising. We had years of transactions, but nobody had ever sat down and explained what many of them actually represented. Like I said, I knew what they were, but my accountant really didn't. But my accountant never asked. I walked through what was coming into the account, which was deposits from my software, bulk amounts with no breakdown, owner distributions, maintenance expenses, loan payments, and all the different software subscriptions. Everything was moving, but when I asked myself whether someone new could step in and understand every single line, the honest answer was absolutely not.
And that's exactly the problem. If nobody understands what a transaction represents, how can your accountant categorize it correctly? How can your staff, if they're doing internal categorization in your accounting system, how can they understand?
Yes, exactly. So I guess what we were going to be talking about is the different mapping.
Yes, Kathy,
situations.
and as we look at this slide too, expense mapping is creating a roadmap that shows every dollar where it should go in your accounting system. And what we've done for Kathy is actually made her a visual transaction mapping cheat sheet, I call it. So when deposits come in, she look at the map and determine that. Let's walk through this example we have on here, which is the Green Thumb Landscaping Lawn Care. Let's look at this transaction. It was a $325 transaction, simple enough. But is it a repair and maintenance? Is it ground maintenance? Or is it a property expense? Or is it a capital improvement if it was a major project? The answer changes your profit and loss statement. It changes your tax deduction. It changes your property expense records. Walking through example 2, a software, same idea with Bullion, $186. Is this a software expense? Is it a property management technology? Is it administration? The answer tells a different story each time. This is why expense mapping matters. Without every transaction, it's a guess. And without expense matching, think about it from your bookkeeper who is seeing this, who's not in your office, seeing these transactions.
Yes, and some of the mapping or categories I was used to using, because I have multiple categories, it may not have translated into the accounting world for the taxes. So now I have to, some of these designations have to be reworded to be correct. So I have to do a little change so that my accountant understands it and we can move ahead accordingly.
Yeah, introducing this concept and reframing it immediately, most owners hear chart of accounts and they immediately tune out. Let me frame it differently for you. Think of your chart of accounts as a filing cabinet for your business. Your business has four main drawers: revenue, expenses, liability, and assets. Every single transaction that flows through your business must go in the correct drawer. Walk through each drawer. Let's look through each drawer and explain them. So we look at on this slide the revenue drawer. And Kathy says that's management fees, leasing fees, late payment, application income. Expense drawer: payroll, insurance, software, marketing. Liability drawer: security deposits held, owner funds, loan balances. Asset drawer: operating cash, trust account funds, receivables, and equipment. If a transaction lands in the wrong drawer, your financial reports tell a wrong story. And the decisions made from the wrong story leads to the wrong outcomes.
Yeah, so I had absolutely no idea how much structure actually existed behind the scenes, which would needed to be more structured, and we started mapping everything. And then these
Yeah,
items, they became more clear to me what I needed to do.
and that's so true. And you see the results of, as you learn those drawers, how you have a different outcome of thinking as it relates to your business, as it relates to those four types of transactions. So most business deal with two types of money: money coming in and money going out. Property management deals with four. Let's walk through each bucket in this slide. Four: company money, management fees. This is Applewood's annual revenue. This is what pays the bills. Owner's money, rent collected. This money belongs to property owners. Applewood is holding in trust. It's not income. Tenant money, security deposits, held pending the terms of the lease. This is a liability, not revenue. Maintenance, vendor money, maintenance payments collected through pass-through contractors, never Applewood money. These four types of money can arrive in the same bank account in the same day. If it's not mapped correctly, you're creating a potential compliance problem under South Carolina Code 4057-135. Commingling these funds is a serious violation.
Yeah, this is one of the most important things I've learned. Not all the money in my account belongs to me. So when I went to school, I was told or taught that you have two accounts. You have the operating account and you have the escrow account for security deposits. That's all I had. So I was putting a lot of my deposits into one account and trying to maintain everything, meaning the repairs, the owner payments, the tenant reimbursements, or anything that I needed to do was all coming from the same account. And that's where I was, not doing well or doing it the right way. So now we are restructuring everything so that I will not have any other issues moving forward.
Yes, and see what they did. It causes that confusion. Now, Kathy's CPA having to figure out and go in and categorize. Oh, hey, these are rent payments. That goes categorized here. This got to be transferred to. And by not having that separate trust account for just rent payments and not just security deposits, the compliance issue, as Kathy said, it was correct in her understanding of her training. The security deposit of that trust account was everything. Was supposed to be rents and security deposits. From an efficiency standpoint, and let's talk from a bookkeeper standpoint, it's just cleaner to have one account for all of your security deposits. So when you're reconciling that account, you see nothing but deposits. Easy to go into that one of those four buckets. Now, Rent deposits now in a new system has its own trust account. Nothing goes in there but rent deposits, and only thing comes out of there is management fees and reimbursements. So now, just by structuring, we go back to when we talked about the structure of your bank accounts. By adding that additional bank account, you just added structure to your accounting. And by knowing your mapping, hey, this money comes in, it's going to go in this bank account. You just streamlined your bookkeeping and understanding for your CPA and your accountant.
Yeah.
What do you think, Kathy?
Yeah, but this is exactly what I was dealing with, and you're dealing with to help me get it structured properly. The bulk deposits that look like revenue but weren't at all revenue. So things that were coming in were being assumed that there was revenue when it in essence was not. So, and other things that were revenue weren't being classified properly. So there was a lot of issues going on with this whole situation.
Yes. And let's make this concrete. Let's take an example of a $15,000 deposit that hits your bank account. One line, the bank is happy. It's really happy. It's recorded deposit. But inside that deposit are likely rent collection, management fees, security deposit, late fees, and owner reimbursement all at once. Each of those belong in different places in your accounting system. Rent collections are not your money, security deposits are not your money, and only management fees and late fees belong to Applewood.
Exactly. Now I know that.
Well, this solution connects three things: your building report, your bank transactions, your accounting entry. All three together tell the complete story, and one of them alone is incomplete. So let's go back again to my recommendation for businesses. And one of the easy fixes of, if you got these four categories, develop four bank accounts. Now, the bank loves me saying that because they got four bank accounts, but we're talking about saving you and streamlining your accounting system. I used to tell clients just 20 plus, 30 plus years ago, I said, one of the things you need to always understand, if you take all of your deposits from your bank accounts, from your bank statements, and at the end of the year, those deposits say 100 grand, and you take all of your expenses, all your withdrawals, say 90 grand. I used to clients, you make sure that when you're looking at your tax returns, it reflects that close to that amount. That should give you your I call it snapshot of your profit loss at the end of the year just by your bank account. So by using bank accounts for those four buckets, it helps the bookkeeper now when he's reconciling, he know, hey, I'm only reconciling security deposits. Great, here's your report. I'm only reconciling rent payments. Here's your report. In the operating account, I'm only dealing with the Applewood expenses.
Right. Basically, when I had my CPA and bookkeeper, I realized I had to be the one who understood what was happening in my own business. And I didn't. I thought I did, but I really didn't.
And these professionals are only good as the information they receive. The owner is the primary source. You got to treat your bookkeeper and accountant just like your doctor. You go into your doctor, the doctor can't really diagnose you, so you tell him, hey, this is the symptoms, this was wrong with me, and then he starts to diagnose that.
Right. Because when we started documenting everything, not just the amount, what it was for, but for each property, which vendor, and everything else that we needed to do.
Yeah.
And go up. Sorry. Go ahead.
No, well, I was just saying that transaction without context becomes a guess. Your financial reports is could be built on guesses. But go ahead.
I can make decisions that I couldn't make before because I can actually see the numbers clearly and understand what's going on. So it's quite a relief because I used to be asked by people, "What's your P&L?" and I couldn't even answer that. But now I'll be able to do that, which is most business owners should be able to do that.
And that's a good. And I used to tell my clients years ago, you need to know your P&L monthly. And I came up with a formula years ago to make it kind of simple. Is you calculate that P&L to daily. Every day, you have a number for the day. That number, my revenue for the day is $150. My expenses for the day is $95. So those as you take that profit loss in the month, you do the dividing by 30 days. And then you have that number in the back of your mind that, look, okay, I need to make $150 a day to make that up. So that is very important in understanding the mechanics that come up with that POL. Delivering, as most people think, bookkeeping means entering transactions to a software. That's what they think. Hey, my bookkeeper puts some QuickBooks together, and that's the only understanding. Let's walk through 4 questions. What happens from the bookkeeping standpoint? The bookkeeping, what happened? Who was paid? How much is when? Why did it happen? What is the business purpose? Which property, which project? Where does it belong? What account in the chart of accounts? The drawer in the filing cabinet. Remember those 4 buckets we talked about? How does this affect profit? Is this an expense to reduce profit? Is it a liability? Is it a pass-through? When your team can answer all 4 questions, every transaction, your books is telling the truth. And when your books is telling the truth, you can make confident decisions.
Exactly. I do wish now that someone had explained it to me this way years ago, but unfortunately that didn't happen. Sometimes you have to go through this rough stuff to understand how important it is in the long run.
Yes, here's the question I want every listener to sit with after today's episode. If you handed my bank statements to a new bookkeeper tomorrow, would they understand what every transaction actually represents? If the answer is yes, your expense mapping is working. Your chart of account is doing its job. If the answer is no, that's not a failure. That's a starting point, because this is fixable and it's absolutely worth fixing.
Yes, the question that stopped me in my tracks when I first heard about this was because the answer for me was no, and it told me exactly where we all needed to start.
The goal isn't perfect bookkeeping. The goal is an honest picture of your business. And why is that honest picture important? Because this is how you make those financial decisions. If we make financial decisions and we have no empirical evidence of our finances, it's a disconnect. And a lot of businesses miss the most important out of that profit loss statement. Really is a cash flow statement every month. Really, truthfully, one of the requirements we should talk to our bookkeepers, hey, can you run me a cash flow analysis going in here? Like say in Kathy's case, and before we end this, Kathy receives her management fee monthly. So any expenses or any pay cycles that within that month is going to put an input on monthly cash flow. So we need to really understand when we make decisions. I'm on a 30-day cycle on receiving revenue. Anything else that I do under a 30-day cycle will impact that cash flow.
Yeah, exactly. Let's see. I want to thank everybody so much for being here for this episode. This was really uncomfortable part for me and personal, but because everything we talked about today is exactly what we've been working through. So we wanted to pass on this experience to people, the business owners who don't realize how important this needs to be.
So true, so true. We've been on a journey this season. Episode 1 asks, where my money? Episode 2 asks why it matters. Episode 3 asks how it moves. And today we ask how it should be classified. Each episode in this series will build on the last and is reflective of a real-time live project that Kathy is going through the restructuring of our financial system. The next episode we'll be talking about hidden cost of disorganization, missing documents, vendor confusion, poor filing system, the real risk that it creates. Whether it's an audit, a tax question, or a compliance issue, the cost of disorganization is always higher than the cost of the system. Don't miss it.
Yeah, there's a lot going to be that we're going to go through. So stay tuned for the next episode.